To allocate resources consistent with value creation principles, management and boards of directors rely on accounting return metrics for guidance. However, our accounting system ignores, for the most part, intangible assets. Consequently, our accounting system is obsolete. This leads to large-scale errors in accounting returns, such as return on invested capital or ROIC. Let's dig into this issue and discuss a way forward. For over 3 decades, investments in intangible assets have been accelerating. Corporations currently invest far more in intangible assets than tangible assets like machinery and buildings. Intangibles are expenditures that will generate benefits in the future beyond the current accounting period. They should be capitalized and amortized like tangible assets in order that revenues can be approximately matched with corresponding expenses, thereby generating far more relevant and useful accounting statements. Intangibles are typically buried in SG&A expenditures and include R&D outlays, employee training, advertising to build up brands, expenditures to improve supply chain and other business processes, customer lists, platforms such as Amazon's website, AI-enabled information technology capabilities, and much more. Let's put intangibles in the context of the life cycle framework and discuss an especially critical decision for management and the board of directors: resource allocation. A firm's or a business unit's life cycle track record offers guideposts to advance long-term value creation. We have previously discussed key value creation issues depending upon where the firm is on its life cycle. These are shown at the bottom of this slide. Accounting returns such as return on invested capital or ROIC and CFROI, cash flow return on investment, are used to assess a firm's position on the life cycle and to judge its skill for earning at least, and preferably more, than the cost of capital on new investments. Large-scale errors in accounting returns due to ignoring intangible assets can easily lead to decisions that misallocate resources. Many years ago, when I worked at Credit Suisse Holt, we made a significant improvement to the calculation of life cycle track records for the Holt global database that is used by many worldwide money management organizations. We assigned accounting lives to R&D expenditures, enabling the capitalization and amortization of these assets. The results were both dramatic and useful for our money manager clients. To repeat, our current accounting system is obsolete. Let's discuss a way forward. Here are the key elements of a proactive management plan to start the evolution of the new economy accounting system by beginning inside the firm. Step 1 is to assign responsibility to chief financial officers to orchestrate an ongoing learning process about intangibles and experiment with the capitalization and amortization of intangible assets that are typically expensed in SG&A expenditures. I have recently co-authored a forthcoming paper, Bridging the Gap Between Accounting Returns and Economic Returns with New Software. The paper is open access and provides a comprehensive analysis of the issues involved. Importantly, we provide a new website with open access software and a tutorial to assist users in learning about the capitalization and amortization of intangibles and the impact on whatever accounting return metric their firm uses. This paper and its companion open access software can play a useful role in the needed transition to the new economy accounting system that explicitly handles intangible assets. The new software is being programmed by Don DeMuro, my co-author on the paper, and should go live in January 2024, along with posting on SSRN, the paper. Being open access, the software can be downloaded by those users who want to develop more advanced versions. Perhaps the large consulting firms, especially the consulting arms of the big accounting firms, will finally get involved and assist management in solving a huge problem that faces every corporation worldwide. Here is our 10th and final takeaway. The new economy accounting system begins inside the firm with an ongoing learning process for intangibles, experimentation with the capitalization and amortization of intangibles, and more accurate life cycle track records, thereby improving resource allocation decisions.